It could get as high as 100% for all I know. And in the end game, of course, they will go to infinity because there will be no silver for sale at all. At least not for dollars. There will be for goods and services, which means that silver will be money directly and not the dollar. Hey guys, Ralph here from the End Game Investor. Today, I want to show you some numerical evidence that the Silverbacks are winning the war on silver. Not really the war on silver, the war on big banks hoarding silver to protect the dollar, or whatever you want to call it. Look, okay, we're winning, all right? Is that enough? I think so. We are doing just fine. You just got to be patient and wait for the big storehouses of silver to drain, which they are doing, and which they have continued to do as late as last weekend, when another 1.2 million ounces of registered silver was drained from the stockpiles. There is a lot of talk on the gold and silver forums, or whatever they're called, that the decline in registered inventories isn't really a bullish sign because it's happened before and the spot price didn't move. Yeah, that's true, except there is a difference this time, and that is this. So I put these boxes around here because these charts don't exactly line up. This one's from 2009 and this one's from 2002, so I didn't want you to get confused with, trying to line it up graphically, which I could not do, but I can line it up in terms of boxes.
Many interesting and important things have been put into boxes over the years. Textiles, other boxes, even children's candy.
Do any of these boxes have candy in them?
No.
Colorful boxes. I love colorful boxes.
When will we be able to see a finished box, sir?
Oh, we don't assemble them here. That's done in Flint, Michigan.
The yellow box. Okay, the yellow box is from 2013, which was the beginning of the collapse in silver prices after the gold bull market. Gold and silver bull market 2011, 2012 started to fall. 2013 was a real big collapse. So this is what happened. Premiums on this bottom chart skyrocketed from around zero in 2012, meaning no interest in physical silver over spot, to about 20%. So what does that signify? That shows a lag in the price of physical silver that did not follow the spot price day to day. And what was happening to the inventories of registered supplies? They were actually going up, which means that the demand for physical silver wasn't really accelerating that much as the spot price was falling. So here you did not have a wake up in the physical supplies. The silverbacks did not exist back then. Nobody was excited about silver. Even in the 2011 bull market bonanza craziness, there was no real interest for physical silver over spot. It was all a speculative game in SLV and other paper silver vehicles like futures, etc. But the premium was actually negative, meaning physical silver was cheaper than paper silver. So it was all speculation. And now what happened here in the black box? 2015 was bear market bottom for the silver market and the gold market in that year. What was happening there was the opposite. So we had inventories falling down to record lows. So here you did see some kind of interest in physical silver because premiums were going up, and this was supplying those premiums by providing physical silver to the physical silver markets. And you reached a low, and at that point of that low in about right before 2017, premiums down here, you see in the premium chart, went down to about 5% or so, not that much. And then in 2020, we have the COVID spike here. And what was really happening was not really awakening in physical demand as much as a collapse in the spot price and a lag in the physical markets, because bullion prices, when you go to a pawn shop, they don't get repriced as fast as the spot market does, which gets repriced by the second by traders. And the spike in premiums here did not last very long. It lasted as long as the spot price was depressed, which means that bullion shops, coin shops, or whatever, online stores like Miles Franklin, Comex, etc., they were not lowering their prices along with the spot price. They were keeping their prices stable. So meaning there wasn't that much of a spike in the physical market demand. This is confirmed by the supply of registered silver. It was not going down. People weren't taking delivery of the physical from contracts or loading out, whatever it's called, from the Comex, meaning metal was coming in. It was the opposite. There was not much interest in physical bullion at that point. But then we have here is the silver squeeze movement begins. Beginning of 2020, and that is the red box. Now this is very different from what has happened last 3 times. This is a steady and consistent rise in premiums with a concurrent, steady and consistent decrease in the registered silver supply. And so we're down to about 44 million ounces from about 152 million ounces. That is about 108 million ounces out of the registered category. Now, if premiums were staying pretty constant, then I would say that there's not much physical demand. However, premiums are going way up. Now, in these other boxes, we do not see a fall in the registered supplies concurrent with a rise in premiums. So here we are seeing an increase, a marked increase in physical bullion demand. People want to take silver and put it in their attics or their basements or bury it in their backyards or whatever they want to do with it. And we're seeing a fall in registered supplies with a rise in premiums. That is the first time that we are seeing this since 2008. And in 2008, we didn't even see it, because here you see it at the very beginning of this chart here, when gold charts started recording this stuff. You see a skyrocketing in premiums from about 10% to 40%. That was during the 2008 financial crisis. And in 2008 financial crisis, you saw a little bit of a fall in premiums, but not much. Sorry, a little bit of a fall in the registered silver supplies, but really not that much. It wasn't that extreme. It wasn't any more extreme than any other fall had been. So still, physical demand was not that much back in 2008. This is the first time since then, or even before, that there is a serious demand of physical bullion. I've shown this one before. This is the physical silver supply in LBMA in London. We just looked at Comex, and it's falling fast, the registered supply. And here is the total supply in London. This over here is November 2021. It is about 1.17 billion ounces. And here is about 915 million. So we have a decrease of 254 million ounces out of the LBMA since November 2021. And now, if you look at SLV, the SLV ETF, total of SLV silver holdings from November 2021, when the drain from LBMA started, we have here about 550 million ounces in SLV, the amount of silver in SLV, this chart over here. And now we have the number 477.74 million ounces. That is a drain from SLV of about 72 million ounces from November, which is when the drain out of LBMA started. So 254 million ounces out of LBMA, 72 of that from SLV, most of which is held in the LBMA. That means there is a 182 million ounce drain from the LBMA, and it is not going into New York, because the total supply of silver in New York in the Comex is pretty much stable since November. So these ounces are going into private hoards. They're going into people's basements, into people's attics, into people's private storage. Who knows, millionaires, billionaires, regular silverbacks, the beauty of the silver squeeze movement, but the fact that both the mega rich and the middle class, who can afford maybe 10 ounces a month or whatever it is, it doesn't even matter, they're all participating in it. When you have a movement of the middle class and the mega rich that are doing the same thing and protecting themselves against further debasement of currencies, of money substitutes, then you know you're at the right juncture for the repairing of society, when the rich and the poor work together in their own capacities, however much they can do. Now, back to here for a second. We saw a fall of 254 million ounces from the LBMA from London, only 72 million of which has been from SLV. That means 182 million of those ounces have been to supply the physical markets, which we see in the skyrocketing premiums since silver squeeze. So silver squeeze has contributed to 182 million ounce drain net from the LBMA, taking out the SLV drain from the ETF. And now my point here is, you see this bar going up, this blue bar, about 8.11 million ounces. Is the second biggest inflow into SLV in the past year and a half, or was it a 2-year chart, whatever it is. If the silver bear market is done, and that means SLV is going to have to restock its supply to keep its price in line with the futures price, then the LBMA is going to have to source silver to put back into SLV, with the Silverbacks still draining physical from the LBMA and Comex. It's going to have to pay premiums for that silver, and the silver slingshot is going to be pretty strong. And the total transparent silver holdings in all of the world, as far as Gold Charts R Us knows, I don't know if they're complete, I hope they are. You see here, and I did this little test with drawing lines on paint after I copied this into paint. The only silver supply that is falling is this one, this big beige thing over here, and that is SLV. All these others are staying in parallel with the fall in SLV, which means that silver is not coming out of these other alternative silver vehicles. It is only coming out of SLV, which means that whoever is storing silver in these other vehicles, they are not redeeming it. They are keeping it there. They are not selling it. They are holding it. They are hoarding it. SLV is redeeming shares in order to supply the physical markets. And so the conclusion, my friends, is this. We have rising premiums ever since silver sweeps from about 5% to close to 40%, and they continue to be around between 35 and 40% physical premiums. In order to satisfy these premiums, the registered silver supply has collapsed from 152 million ounces to about 44 million ounces and is falling almost every day now. In order to clip off more silver to supply these premiums, to supply these physical markets, SLV has been liquidated, helped by a falling silver price, spurred by the shorting of SLV shares by the bullion banks that participate in the SLV fund. And so by shorting SLV, they're able to redeem some silver from that fund to supply the physical markets. But the minute that the spot price picks up, that means they're going to have to put more silver into the ETF, which will compete with the physical bullion markets, where premiums will only rise further as the physical demand keeps growing and growing, because the silverbacks are not letting up, and everyone seems to be aware that the dollar's days are almost up. And so as the spot price rises, the participating banks in SLV are going to have to source silver to stuff it into SLV, competing with the physical bullion markets. And we should see premiums go to all-time highs of 50% and above, I believe, for junk silver. And who knows where they could get for silver eagles. They're already around 60%. They could get as high as 100% for all I know. And in the end game, of course, they will go to infinity, because there will be no silver for sale at all. At least not for dollars. There will be for goods and services, which means that silver will be money directly and not the dollar. This is Rafi of the Endgame Investor. If you want to know more about silver and gold, then consider signing up for a 2-week free trial of the Endgame Investor, where I talk about this stuff from different angles, not every day, well, 3 or 4 times a week. You know, I got to get a break sometime. And if you're interested in a biblical perspective on the monetary realities of the world, please consider signing up to be my patron on Patreon for as little as $3 a month, where you will get a weekly video of biblical commentary on monetary policy, economic, and governmental topics. And I have to put one out today because it's Sunday. I'll see you guys soon.